Yeah, good evening, everyone. This is Nitin Jain here from Research in India. I'm the moderator for the today's webinar on recent trends in venture capital investments, focusing on key emerging sectors. Right? So, to give you a perspective, and before that, I would like to tell you about the eminent speakers that we have in the panel today. So, we have Mr. Alok Mehta from Bloom Ventures, who is the head of investor relations. Along with this, Mr. Sridhar Narayanan, who is founder and MD of Pegasus Fininvest, and Mr. Manoj Agrawal, who is MD at C Fund, Mr. Rajiv Sambal, Director of World 5 Capital and Beyond, and Professor Dhruv Nath, Director of Lead Angels. So to start with, I would say, venture capital has been a buzzword in the entrepreneurial ecosystem. And whomsoever is listening to this term, they want to, or I would say most of them want to get associated with venture capital in one way or the other. One of the obvious reason for that is the businesses are always in need of funds, right, to achieve their growth, sustainability, and to ultimately get to their vision or mission. Right? A lot of traditional funding channels are facing challenges because of their various reasons. Or we can also say that the traditional channels cannot fulfill all the requirements when we have a lot of innovative startups coming up and they have large funding requirement. Right? So that's where the venture capital and private equity funding is coming to play, and they have been kind of very instrumental in changing the whole ecosystem. So they have been following a very dynamic and innovative approach where they can cover a very large spectrum and are ready to listen to new ideas and even at a very early stage and support them all through so that they kind of ultimately achieve a very exponential growth and become a unicorn and make us a notable change in the ecosystem overall, right? So that is the perspective we are taking forward. So we want to understand that what has been the focus of funds and what kind of startups and company they want to look at, and what are the sectors which are has been very critical before the pandemic and during the pandemic and even after the pandemic. Right? So we'll try to cover all these situations. Right. So before I start questioning or interaction with the eminent speakers, I will present a couple of slides to indicate investment in certain sectors. So Rohan, can you put up the slide? Yeah, just go to the next one. So, I would say, we haven't done a very detailed, or we are not presenting a very detailed research. But what I'm trying to indicate here is that the sector which have raised maximum funding, and there has been, a lot of, larger number of deals in terms of numbers. Right? So here you can see that e-commerce, financial services, and technology, both in 2020 and 2020, got the maximum funding, right? So there are other sectors who are, also getting a lot of funding, and as compared to 2020, there has been, much more investment in 2021 because of the pandemic. But yes, the sectors who were earlier more bullish and they were able to reach out to larger audience, they're still kind of more approachable to investors, and that's where the investor would like to understand the business model and how they kind of bring the value add. Go to the next slide, Rohan. Please continue to the next slide. Rohan, I think the slide is not moving.
I think there's some network issue.
Yeah. So again, we are showing the same scenario in a different perspective. Just go back to my last one. Yeah, so here we are only showing the number of deals. So you can say the financial services, there were more than 150 investment in 2021, it crossed more than 200. But again, it remained on the top slot, right? So one can understand that, okay, if somebody is pursuing, a venture in financial services, that can generate a larger interest. But yes, it will be important to understand what kind of product and solution that the one is trying to offer and how it will benefit the ultimate client or the audience. Right? So similarly, we mentioned other sector as well. But again, to showcase that it doesn't really mean that some sector who is getting a less funding at this moment will still be challenging to raise funding for that sector. So one can think of what is the innovation or the ultimate changes you want to bring in the ecosystem, and then definitely the investor would be more than happy to listen to that. Right. Continue with the next slide. So just kind of showcasing a certain recent updates. So India has been one of the fast-growing startup ecosystem in the world. We are as a rank, we are third in the world after US and China. But currently we have more than 100 unicorns, and more than 20 just came in the last quarter or last the first half of 2022. Right? And one thing I can tell the panelists and the audience as well. Before the pandemic, I did an event where we took the topic as 100 unicorns by 2025. And now you can see it's before the end of 2020, we have already crossed 100 unicorns. So you can imagine what was the perspective around 2018-19 and how aggressive it has become now. So startups, investors, and different partners, they are all aggressive over the ecosystem and the kind of change it's bringing in the overall lives of the people. So you can understand. So there is a large scope, and investors are ready to listen. So people can definitely take a plunge and start their own startup. Right. So there are 14 sectors recorded over $1 billion investment that includes e-commerce, technology, and the sector that we have just showcased. Right. So and in all of the, like I was mentioning earlier as well, that the VC spectrum or the VC investment is kind of critical nowadays. So you can see from the last comment that more than 87% of the investment, of the total investment size in the country is happened through PE and VC funding, right? So you can understand the magnitude of it and the importance of it in the long run, right? So now I would like to now come to our eminent speaker, and I will start with Mr. Alok Mehta, who is the head at Investor Relations at Bloom Ventures. So, Mr. Mehta, I would like to understand from you that we have seen recent investment scenario, and while there were a couple of sector where the large investments has happened, but especially post-pandemic scenario, which are the sector where the fund is more bullish and you are expecting to see the startup who can be register significant growth in the near future? Over to you.
Nitin, that's a good question. So personally, and even as a firm, we don't believe that there is a pre-pandemic or a pandemic era. Reason being that when we are raising funds from our investors, we are raising these funds for investing and exiting over a 10-year cycle, and these cycles are secular, right? So a 1-year event or a 2-year event will not make a lot of difference to the journey of 10 years when a founder is trying to build a company. Because again, and this is my perspective, because we invest in early stage businesses, right? That is when the founder is coming with an idea, he has a minimum viable product, there is some proof of revenue being generated, and that is when we as in Bloom is the first institutional investor into that company. Right? So our outlook would be more like measured over a period of time. You'll have a view on a sector, and within that sector, we'll identify themes which would hold relevant, right? If we were to talk about sectors where we are bullish on right now, right? Not right now, we have been consistently bullish upon. I would list down 5 sectors, right? Fintech, because, and it is not that we have suddenly become bullish on fintech today, right? But what has happened over last 5-6 years is we have created a world-class digital fintech, infrastructure in terms of Aadhaar, the, GEM trilogy, all of that, which is like a instrument like UPI does not exist in many developed countries of the world. We had a LP visit us from Europe last week, right? And we showed them like what UPI does. We just simply transferred money like in a second. And they said that, I mean, this is not something that they have like, no one is creating these kind of products in a supposedly very advanced like geography like Europe.
I understand.
So fintech we would continue to be bullish upon. There are lots of good ideas coming up there. Some of these are more fin than tech. Some of these are tech because arguably whatever is happening around crypto is also fintech.
I understand.
It is actually very much fintech. Right? So fintech and again what we also have to keep in mind that these kind of ideas, whatever new ideas come up, they should be solving a real problem.
I understand.
Now the problem of payment, a laborer in Bombay transferring money to his bank account in somewhere in eastern UP, that is solved by UPI or whatever other developments that have happened. So we are solving real like on the ground problems at scale, and that is what matters, which is why we continue to be very bullish on fintech as a sector. Education in a country like India, which needs to educate people, education continues to be very important. And of course, uh, there are various arguments around, how there was a pandemic tailwind and then suddenly everything has come down crashing. Now, education also is not like one vertical. We are not always talking about test prep. We are also talking about, for example, skilling. So we have invested in a company called Unacademy. Right? Unacademy does a lot of test prep, education, conventional like e-education, etc. But they have also created a very strong product called Relwell, which is around skilling and testing. So we are firm believer that education will continue to grow in India. There will be ideas which will be moving more towards skilling, creating employability, creating skills. Even if like it is not like job market skills, it could be, for example, something that you want to learn. It could be languages, it could be anything else. So that's a very strong sector. Another theme which continues to be very strong is SaaS. That has been an evergreen opportunity for India because we have a lot of tech talent which is creating global products from global markets. So SaaS in terms of tools for developers, tools for creating tech infrastructure, tools for creating efficiencies, all of that will continue to see like great momentum. Even something like vertical SaaS, which is SaaS focused on particular areas or sectors. Right? Again, like one sector which I would definitely want to talk about is deep tech coming out of India. So we have seen a lot of innovation, of course, like helped by the policy and the regulatory environment in India. And we are going to see a lot of this in coming years around electric vehicles and associated, associated use cases of those kind of technologies which are coming up. So these are some of the few sectors that we keep on like developing thesis around. That is how we think about this.
Thank you very much for your detailed giving the detailed overview and the focus of the fund. And one thing I think you have mentioned for the knowledge of the audience, that the funds are not really changing their strategy in the short term, right? So they have a fundraising with the vision of 7 to 10 years, and they continue to focus on that. And there may be certain challenges come because of certain economic and other conditions, but that still the fund would like to continue on its part and focus on the sector which they are already following. Right? So thank you very much for your insight. So now I'm coming back to Mr. Sridhar Narayan, right? So Mr. Sridhar Narayan, I would like to understand from you that there has been a lot of investment startup where sustainability or the profitability is not really part of the near future. But yes, the pandemic and certain economic stage situation has put back the focus on the sustainability of any startup or the growing company. Right? So do you think there are, few sectors who can achieve early sustainability, or whether do you follow a strategy that it more depends on the business plan and the go-to-market strategy of any startup? Right? So, because a lot of startups, they have a less understanding that how soon their startup should be sustainable and when they should be able to generate profit. So if you can just put some light on that, that will be helpful. You're on mute, sir.
Sorry, I was on mute. Thank you for the question, and thank you, the surgeon, and thank you, my dear fellow members of the panel, for this opportunity to be talking to you, all of you, and the other participants. See, investing momentum in India is primarily driven by the digital infrastructure development, like you said, cheap data access, UPI, eKYC, Aadhaar, which primarily drives most of your fintech, etc. So now, if you read the latest reports, as I see, this digital economy accelerators are a key to the entire venture capital environment, because obviously there are startups and there's a momentum, which is, the tailwinds are all of the disruption in China. Then, you can't invest in Chinese startups and stuff like that. So there is a lot of interest which comes into in terms of the startup ecosystem that we develop in India. Now, but the investing in startup is actually, or the ecosystem of the VC is always troubled by the fact that by the very name venture capital, it says that you have to enter into a venture, but then you don't see. But then most of the time, people in the tech space, and mostly because every tech space there could be an idea, we used to ask those difficult questions, which we thought was difficult. Do you have a product? Do you have a service? Do you have a thought, or a solution to this problem or a service? Then you could have a venture. But I think now it's much more pivoted towards matured way of doing VC investing, where we really need to see whether there is a light at the end of the tunnel. I mean, I primarily focus, I'm not a typical VC style of investing. It's a mix of VC and PE style of investing, where we really require to look at the operational sustainability of the model, of the business model. An idea, when you fund, it's a seed fund, so it doesn't come to the VC or the acceleration stage. So fundamentally, I think, so those kind of challenges you see not in a matured investment that you do at a Series A or Series B, but it could more be likened to when you start early stage. We also do early stage, but more importantly, we see whether there is a light at the end of the tunnel. That's what I keep telling the entrepreneurs, whether they are tech, whether they are fintech, the SaaS, because there could be an idea. I mean, look at fintech. I mean, I've been looking at some innumerable number of fintechs. I mean, there are fintechs which have lost money during COVID, 10% of NPAs, So it's all about how you pivot the model, and actually how much of digital infrastructure you use and how much of brick and mortar do you really use, and you call yourself. So, we have these kind of parameters, and also being an impact fund, we also look at responsibility metrics. So we developed a very specific series of investment metrics, which we need to have these companies meet, especially when I talk about, light at the end of the tunnel. I mean, I believe in sustainable operating cash flow model, period. Even if you're in deep tech, you let me know. For example, I invested in AI and ML company, and I understand that's more value driven and it takes a little bit of time for it to really. But yeah, except for those exceptions in deep tech, you basically look at all the other SaaS related companies, fintech companies, all should literally have some kind of a plan. And if you're convinced by the entrepreneur and by the technology available and the variables around it that there is light at the end of the tunnel, an operational sustainable model, we normally put a lot of time. And unlike, we take a little bit of incremental time for investing. So like we must have 7-8 investments till now. But yeah, in the last 2 years. And we are happy in the current situation, because then there is a liquid or dry powder less. We have got our companies obviously due to COVID impacted, but sustained and moved over. So what was the point which really helped us to do it was the fact that we looked for this operational sustainable cash flow models, which I think is one of the key pieces that we work with, along with the impact model that we have. So that applies to technology sectors too. So it's a way of how you look at it, So we said you should be investing without fear and greed, and you should be, because then you don't shortchange an investor or an industry. You need to have a perspective and develop and operate within an operationally sustainable cash flow model. If you don't see that, go ahead. And then the third point is that, nothing given free is value. So obviously, if I'll subscribe, I've got X amount of subscriptions, I will hit. A lot of people come and the first task is a 10 million or 20 million as valuation from seed stage to early stage. And it doesn't make sense. So I think those types of VC investing days are over. So it's much more clear-cut view in terms of the technology, the use of technology, and more importantly, whether you can fulfill a need and a service by technology. Is it going to be a sustainable model? Do the consumption of the technology is going to be a service or for a long period of time to come? It's something which you need to really look at, because it also has a very direct impact on the ecosystem and culture of the way we work and we do things. We are all talking about now metaverse and what metaverse can do, but we all don't understand how much of impact it will have in the way we live when we think.
Yes.
Obviously, there will be blocks. It's like blockchain. We have been talking for a long period of time. How much of it are we able to use? Forget the crypto part of it, because that's got its own risks and rewards, metrics playing out for itself. So I think it will become much more interesting, and while the VC investing market will continue to dominate, and it will be towards your fintech, SaaS-based and healthcare, health tech-based kind of investments going forward. It will also look for very sustainable operational model, and which brings to the point that I think Alok mentioned, and that was about the guy needs to have a 10-year vision. And you really have to figure that out. So it's point one is the entrepreneur, point two is the entrepreneur, point three is the entrepreneur. Basically, if you have people taking out a tech startup and say, because a lot of people don't go for jobs now, IITs, IIMs, they say we'll do a startup, finish first one, take it up for valuation, and then it's like so it doesn't make sense unless there's no real growth. It's like real and nominal rate of growth. So that's the kind of expectation people have, and they say that I'm going to do my own startup. So VC investors like us and like all the people out here should be very clear that they'll only back now sustainable models, or you may have an idea and we'll work with you to make it sustainable. We'll try to pivot it towards that. See, that is acceptable.
Yeah, thank you very much for your detailed overview. And I understand that now any startup was looking to approach VC for funding, they need to have a point where they see their businesses to be sustainable. And it's not only aspect of users or the client, but it's also like how they're commercially kind of interacting with them. So thanks very much for this. Now I would like to come to Mr. Manoj Kumar. Right. So, sir, I would like to ask you that there are so many sectors in the ecosystem which has been operating for quite some time. So, like we are discussing healthcare and financial services. Now, one cannot expect that there will be a totally new sector or the sector coming in the picture in the quite frequent manner. But what's your view in that, for founders to kind of identify the subsector or the segments which can, kind of highlight their own value add and better connectivity with their audience, and ultimately, follow a path of exponential growth. So the point I would like to, make is that, we have a list of sector which everybody is able to relate to. But under that, how is important to identify a subsector and create your own value? So, and what's your advice to founders regarding that? So yeah. Over to you.
Thanks, Nitin. Pleasure to be part of this panel. Very interesting question. Yeah, so we all know about the broad sectors, right? We've already spoken about fintech, health tech, e-commerce, SaaS, and broadly deep tech. Deep tech itself is so huge and so broad because there can be subsectors within deep tech, right? And we can go deep down. Deep tech can be deep down. So I mean, for any founder, when he looks at a venture like Mr. Sridhar mentioned, today everybody wants to do a startup and be a founder. So one key element is to look at yourself, like what do you understand well? Like what is so need not be a sector you have worked in, but at least it has to be a sector where you have done some work on, you understand the space, typically we have seen that founding teams are more than one, right? And most businesses are technology driven. So it's very important to have a founder who understands technology, especially the technology or the space you want to work in. So build the right team. So even before you look at the sector, or sometimes you have clarity, right? Some founders have clarity. I want to do so and so. But if you don't have, then you need to have a tech founder if technology is an area you want to work on, and somebody who understands the business side of things, the sector itself. Now, which sector? It's very difficult to say, you should look at this sector, but I can give you some broad views, right? One of the key elements, the way businesses have come up in India, if you see, is ideas from West have been adapted into India or the East, I would say. So you continue to look at ideas in different sectors or subsectors which have been coming up in the West, but then don't blindly follow them. You have to see whether you can adapt them to India. Some ideas may not just be workable in India, and we have seen those examples where it doesn't work in the Indian. For example, autonomous vehicles. I mean, like it or not, you can do work on that, but it will be long time before it can be adapted to India. But you can always sit in India, develop the technology, because you can develop for the world. So what are you looking at? Are you looking at building a business for India, or you want to build a business out of India for the world? So within sectors, you have to analyze what is your core strength and then look at sectors around that. For example, we spoke about fintech, right? There's a lot of work which has happened in fintech over the years. It has been the largest funded sector. Similarly, I see that opportunity growing in health tech, because we are seeing infra developing in health tech. For example, the health tech stack work is happening on that. Like the fintech stack was developed, UPI, Aadhaar, and all that. So there is Aadhaar is anyway universal; it will apply to every sector. So we see that the government and there are bodies which are working on developing the health tech stack. So there will be business model innovation around that. Within e-com itself, there is a lot which can be done. We have seen broad e-com, then sectoral focused in e-com, then business model innovations, social e-com, and all kind of stuff. Now we have seen D2C growing. D2C itself could be a 500 billion opportunities in the year to come, which is a mix of physical and digital, right? So if you are somebody who understands particular space in the consumer product space, that is something which you can look at. We have seen some wonderful work happening there. Logistics technology, green energy, or green tech in general, sustainable technologies. Those are areas where a lot of money will go in, both in India and globally, and you can work in those areas. Green fuel. So broadly, there, SaaS is something which will be evergreen. No, you continue to innovate in marketing automation, ad tech, and so much is happening on SaaS. SaaS itself is a growing sector. People are doing innovation in SaaS for SaaS because SaaS itself has become so big. So I'd say understanding your core strength, having the right team, and then looking at areas in which you want to build, rural tech, agri tech. See, development in deep techs will also bring in new areas of market business model innovations. For example, as IoT becomes more advanced, you can use the technology to, develop various agri-tech focused areas, green energy focused areas. So many areas you can get into business model innovation using technology developments which are happening. That way, technology businesses will also do well, and you can use that for business model, because a lot of work in India over the years has happened, if you see, on the business model innovation side, where we have used technology to deliver a product or to provide a service and things like that. But deep tech is something which will continue to grow and get used in different areas. So this is broadly what my thoughts are around this.
Yeah, so thanks very much for your inputs, and understand that the startup first understand their own sector, understand its dynamic, and then try to build a solution which can be, targeted to a very niche aspect, right? So, and that's, kind of give them a way forward for our long-term roadmap, right? So thanks very much for your insight. So now I would like to come to Mr. Rajiv Semwal, right? So, sir, there are certain challenges in the investment ecosystem because of the pandemic, right? And with this, we can understand that it's important for funds as well to remain relevant and understand the startups in a much deeper sense, right? So, what your advice as a fund or towards the funds as well to remain relevant and to remain more approachable to startups so that the interaction and the sharing of thoughts and the prospects is continued, and ultimately there is no downwards trend in the investment ecosystem, right? So your kind of your views on that.
Well, see, I am, compared to the stalwarts here that you have, I am a new player in this business of VC investments. However, having done my little bit of experience, I've been in this business now for 6-7 years. I have a different take in this whole thing. Number one is that I define technology in two segments. One is the creation of the core technology, which gives you the platform to use it in business. And second is that platform. Use of that platform in the business. Developing that platform is a long-term project. It can't happen in a period of time. The cruel reality of being in VC business that I have seen is that I have 5 years to invest and get out. If I don't do that, my investors will come banging on my door that where's my money? And in that time, I don't think I can go into development of core technology and come back with a return for them. So that first thing is that segregates me from getting into certain business. Then when you have a platform, the way I look at it, and whether it's pandemic or non-pandemic, see, the point is, I tell all my venture promoters that you identify the problem that you intend to solve, whether it's in the area of finance, it's in the area of agriculture, it's in the area of education, it's in the area of supply chain, whatever be the retail, whatever be the area of, fashion, the multiple business. Identify the problem. I actually always make it a point to ask the venture promoter to sell me the problem. The product that is being designed is to solve the problem. If I can understand the seriousness of the problem, then understanding the product becomes simpler. Then whether that platform that is being used to create that product is, in my little experience, I've seen number of times requires a dramatic change purely because it may not be able to sustain or bear the hockey stick that has been presented in the business plan. So my approach to always all my venture promoters is that first sell me the problem, make me convinced that this is a problem worth solving. And if that makes sense, then let's look at the product and then see what are the, and then bring in a capable person who understands the platform to make sure that the platform is right. And hopefully that venture will work. As a fund, we believe seriously in there is a whole, all of us, bar none, gets into a lot of quant data analytics for any venture that we're looking at investment. We have actually started evaluating the qualitative data, and we feel that that is more important, and that is where the team and the team cohesion and the team compatibility comes in, and we actually spend a lot of time trying to evaluate that. Because if that is right, then the aspect of growth comes in. If you identify the stumbling blocks which can come in the way of the delivery of the plan, then that helps. And that is what, what I understood from this is that. And so I will tell every venture promoter that please research. What does Bloom do? how is Bloom's portfolio made? What does World 5 do? How's World 5's portfolio made? Research on us, just like we then eventually will research on you, and go to the right guy. Don't go to the guy and say, I will do what you want me to do. That's not a convincing argument. Does not convince me at least. So I tell all the vendors that, research on us. I mean, what the hell? Every data is there at the marketplace. So there's nothing to hide there. Research and go to Bloom with the thing which Bloom likes to listen to. And then fine. You'll probably have a better hit rate with them. But go to Bloom and say, listen, I want to do this, which Bloom in the whole portfolio list is missing, then Bloom might just throw you out because that's the reason because it's missing. So research on us. Don't try to do what we want you to do. Come to us that this is your area and here is my solution and here's the problem I'm solving. And sell me that problem. You're a very high chance of making it out if that works. That's my simple understanding. And this, I saw your question about the effect of the ecosystem, etc. You yourself saw your slide number 1 and slide number 2. There's no impact on the ecosystem technically, right? However, if you define startups, you mentioned that there are 103 unicorns. If you define the startup as government of India defines, I do not know how many out of those 103 go out as a startup because they may not be considered startups now, and that 103 might just drop down, so the reality is different. But having said that, the growth rate of startups has not reduced despite of the 2020 and the 2021. So I don't think there has been anything. We are still, we are just like you evaluate those business plans. We are at that stage where the E curve is just flying up. At some point in time, it will get horizontal. We are not yet there. We will reach there eventually when we are number 3. I think we're considered the 3rd largest ecosystem. But the number 1 and the number 2 is still way ahead. By the time we reach there, we'll also plateau. But so I don't think the pandemic has, as such, to my mind, it has not made a difference in the startup ecosystem. That's my evaluation. Money has always been there. I have not heard of anybody saying that, listen, I'm not finding it. The only thing is you don't do the research work right. And then you can't blame Bloom for not investing in you because you did not research on Bloom. I mean, come on. You go and do your research and go with the right solution and probably Bloom will come on board. What the hell?
Thanks very much for your insightful comments. And I think the people should follow a very structured approach and a step-by-step approach to understand the fund that they are looking to kind of interact with and showcase their potential. Understand the whole ecosystem in much better way, and then only expect a kind of funding closure and growth in the long term. Right. So thanks very much for your insightful. Now I would like to come back to Mr. Professor Dhruv, and I would like to understand from it's nobody can ignore the importance of an angel investor, right? Especially I would say after the pandemic, where importance of an angel investor at as a first investor or early stage investor is more critical, right? So I would like to understand from you that the importance of angel investor has become even more after pandemic, or what is the strategy that the angel investor is following in terms of looking at more startups to invest, right? So your views on that.
Okay, thanks, Nitin. So first of all, before I answer that question, I just want to clarify one thing which you have mentioned in your slide, and I think Sridhar spoke about it. Everybody talks about the fact that India has 100 unicorns, and I think you mentioned 103, right? That's a very nice thing to talk about. Wonderful to talk about. It's not the right measure. Very simple, right? And I fully agree with Sridhar on this. The point is, the purpose of a business is not to raise more and more funds at a higher and higher valuation and keep making a loss at the same time. No, that's not the purpose of business. I remember Rakesh Jhunjhunwala saying this very bluntly. He says, how can the profits of a company be equal to the next round of funding? He says, I don't understand it, therefore I don't invest in this. Point is, a business, any startup, see, it may not be profitable today. Nobody expects early stage startups to be profitable within the first 2, 3, 4 years. They may not be profitable, and most likely they will not. But there must be what we call a path to profitability, path to sustainability. And therefore, I would say rather than looking at this 103 unicorns, probably a better measure would be how many startups have actually survived and are sustainable today without additional funding. If you look at it, among the large ones, there are probably only 2 or maybe 2.5. There is InfoEdge, there is India Mart, and now you have Nykaa. Everybody else is loss making and is happily continuing to make losses because somebody is putting money into them, right? So wrong measure. Okay, getting back to your question. So you're right, angels are important, and angels are, they invest at a very early stage. I don't think any change has happened during the pandemic because I think some people mentioned, these are long-term things. The pandemic is a 2-year cycle. Hopefully it'll, either die out or, it'll become a very mild version over time. I just want to spend a couple of minutes trying to explain to your viewers the difference between the angel and the VC, and therefore, what is the difference in the decisions they take, which would explain why you would need to go to an angel versus a VC or vice versa. Okay. See, essentially, it is very similar to the difference between investing directly in the stock market versus investing through a mutual fund, right? If I were to invest directly in the stock market, maybe I like Mukesh Ambani's face, or maybe I like the figures he comes out with, and I will invest in Reliance. I have no problem, right? But I may want to invest in the stock market. However, A, I don't have the time, and B, I don't have the know-how. So what I'll do is I'll give my money to a mutual fund, and the fund manager will invest that money on my behalf, right? Angels versus VCs is fairly similar. Of course, I'm oversimplifying, but it's fairly similar. Typical angel will invest his own money, whereas the VC will take money from other people and invest it on their behalf, correct? Now, if you look at this fundamental difference, that is what explains the difference in behavior. So the VC has taken money from other guys. He cannot take too much risk because if he does, his business as VC is finished, right? The angel can say, look, I mean, I've got 1 crore to invest or 2 crores to invest. 90% of that will go into one company. No problem. It's his own money, no issues. The VC cannot do that because if the VC does that and the decision bombs, that's the end of his business as a VC, right? So fundamentally, the angel takes much more risk, although with a smaller amount, and the VC has to take less risk, which also means that the angel typically invests at an earlier stage when the business is not yet solidly proven. It's fairly early, right? Whereas the VC will invest at a later stage where the business is much more proven, risk is much less, and therefore they put in a larger amount. So now getting back to your question, I don't think the pandemic has made a difference, but yes, at an early stage, you find it difficult to get VCs. There are exceptions, of course. For example, I know Bloom also invests at an early stage, but generally VCs invest at a later stage when the business has proven itself. But if you want early stage funding, let's say your revenues are say 60, 70 lakhs or maybe 1 crore in a year. Typically, you will have to go to angels, and therefore angels in any case, whether it's pre-pandemic, during pandemic, post-pandemic, in any case they are required.
Yeah. So you very well, put in, Mr. Nath, and you very well outlined the importance of angel investor and the kind of risk they're taking, and they remain, crucial to any startup and to give that initial push to that story, so that it becomes visible to any VC in the longer run, right? So thank you very much for input. Because of certain challenge in the timeline, I will quickly come back to Mr. Rajiv Sehwal, right? Because he has to leave a bit early. So sorry, Mr. Alok, but I'll just ask a quick question to Mr. Rajiv. So, Mr. Rajiv, I would like to understand from you, being an early stage investor and many startup, angel investor, maybe they are able to get introduced to one or not. Straight away, they want to approach any venture capitalist, right? And sometimes their approach is not very structured. They do not have a proper business plan or even a PPT to showcase the potential of their venture. Right? So in this, because of this, it becomes challenging for VC to understand the business and its potential. right? So as an early stage, we see, how you overcome this challenge and what is your advice to the founders in this regard so that they, follow a step which is, more favorable for the ultimate closure of any, deal with the venture capitalists, right? So the point I want to make is that, a lot of the founders do not follow a very, kind of predefined or structured approach to get introduced to VCs, right? And many of the elements which VCs are looking at are missing in the pitch deck or the business model, right? So how do you kind of, approach this kind of, documents in the founders and ultimately try to bridge this gap?
See, the thing is that ventures do approach, and they approach everybody in general. And so one thing, and I can speak for myself and our fund. I cannot speak for the industry. I'm not qualified to do that. But when I look at the ventures that come to us, as the Professor Nath said, see, we are holding someone else's money. We are not having our own money there, right? And therefore, to that extent, the liabilities and the responsibilities, though we are legally protected in many ways, and I'm not getting into that, the liabilities and the responsibilities for a business to continue go beyond the legal protection that I have or the fund has for its magic partners. That essentially puts me also in a situation wherein we have to get very critical. So I'm repeating what I have said before, that, and I don't blame the venture promoters, because you see, most of them are youngsters, 1 year, 2 years of work experience, 3 years of work experience and setup. So the eagerness, most of the time takes over the whole exercise. So my humble opinion to each one of them would be that please, research on me. Don't come to me without researching on me, because you will have a lot of insights on what interests me and what does not interest me. And be very clear about the problem you're solving. See, most of the time I have seen in my little experience that people are more interested to promote the product. Don't sell the product. Product will sell itself if I understand the problem. And having spent n number of years behind in the industry, one thing I understand is problem. So if that problem makes sense to me, the product will be sold automatically. That is a thing that they need to focus on. But easier said than done. Most of them, in their eagerness and their zeal to raise money, quick money, overlook this. But if they were to focus on this, this would help them a lot, in my opinion. We have a very, and I can bet my bottom dollar on this one. There are 3 big funds sitting in front of me who I can see on the screen. I can bet my bottom dollar that if you ask them on the efficiency ratio of number of applications versus the number of portfolios, it would not be in double digits. And that is the sad part. So it's easy to say we have got 65,000 startups. 60% of that is technology-based startups. That's 36,000 startups every year. How many get invested, and how many get rejected? Purely because the focus has not been clear.
So,
and that is it does not make me happy rejecting a company, but what to do?
Yeah, so I understand
there has to be that homework which has to be done.
So there cannot be no casual approach. So the elements which are critical for understanding any VC or investor, that has to be part of the business plan and the presentation, so that an informed decision can be taken. Thanks very much, Vivi. So I'll come back again to Mr. Alok, and I'll just put up a bit of perspective to you, that we have seen recently that the Byju was playing as a pure online education platform, right? But since the pandemic situation is easing out, and recently we have seen they're opening their tuition centers, right? So There may be other cases like that where the companies during pandemic they generated exponential growth, and after that since the people are starting their product or solution may not be as relevant as it used to be. So in the longer perspective, as a fund, how you kind of deal with this scenario where the business model need to be pivoted in a very kind of a significant manner, and then again ensuring that the venture remains sustainable and generate consistent growth in the long run.
So that is, so Nitin, this is again like a situation where we need to clearly define the business model, right? Now I can argue from the other side that Byju's is in the business of delivering education, right? In the most efficient and the most scalable manner. Right? So no startup should be bound by a business plan, which like limits their ultimate mission. Again, Professor Nath had a very good point, which is again, one should never be losing sight of that path to profitability, right? These pivots should all be aligned to that ultimate path to profitability that the founder thinks that they are taking.
Okay.
So ultimately, pivots is something that we keep on seeing every day. Right? Pivots are a part of building a sustainable business. Pivots are not a crime in the world of a startup. Right? Again, these can't be reactive pivots. These have to be pivots which are very well thought out. And ultimately, as investors, like we have to believe in and support our founders on how they are thinking about building their businesses. At the same time, we have to work alongside them to help them shape their businesses. That is our role as investors. Some of these businesses, as I said earlier, have seen a secular, pattern of growth, which is not going to be like limited by, a certain time period. Because there is a certain, again, like something like pandemic, if you were to think in, that manner, there has been a very clear change in how we think about digital, how digital delivery happens. That the entire rate of adoption has changed. So most of these business models would be sustainable in the long run, right? As has been pointed out, we are in a secular tech growth phase. A funding winter here and there would not stop that journey because we are a country which has great aspirations. We have the talent, we have the manpower to execute on those aspirations, and tech is what will propel those aspirations.
Thank you very much, sir. And I think you made it quite well. Again, highlighting the point that you are with the venture in a different scenarios, and your commitment with them is remain whatever the situation is, and you are ready to kind of make any adjustment so that the journey is stays on. Thank you very much. So now coming back to Mr. Sridhar, and I'll make a point here that while we interact with our startups and other businesses, many of them feel that they are running a traditional business and they are not straight away or direct match to expectation of venture capitalists. So a lot of traditional businesses maybe asset heavy or maybe running in a very traditional manner without following any proper structure. So they initially feel that the venture capital is not for them and they're not actually for them. Right? So do you have you want to advise those promoters and the management team that there are certain steps that they can take so they become more approachable to venture capital, and ultimately since their business is profitable and having certain growth in the period as well. So again, venture capitalists would be keen to know that story, and there will be a situation where they can be expect a venture capital happening in their company. Right? So your thoughts on that? Sir, you're on mute.
Venture, thank you for the question. But venture capital, as I see, by the very nature of it, is risk capital. Now, fundamentally, it's driven predominantly by tech, digital transformation, and obviously asset-light models, because traditional businesses are asset-heavy, and people normally then you get into sectors like real estate, infrastructure, and power, renewable energy is one more example. Now, allied technical challenges of these sectors are again broken up into startups, and where you see a lot of VC funding and VC investing happening. So what I watched over the last, and if you look at the 38.5 billion, the numbers that somebody throw, that unicorns, these all, if you see, these are all models of, with a substantial amount of tech involvement in the businesses. And that's why, as Professor said, that we already have 3, 4 or 5 of them in, and fulls of them really count in terms of profitability. That way, the traditional business model scores, because traditionally people used to put their own equity, wait for the debt, whether it's 1:3 or 60/40, 70/30, depending on the nature of the business that you do and how much you can service. So there are a lot of planning, thought going on to it. Right now, startups is a business, VC is a business. So each has its own model and code of conduct and rules and stuff governing all of them, right? So end of the day, to move traditional business into VC investing model, I think traditional businesses which are large in asset heavy will normally go to private equity, PE funds. So VC funds will still concentrate on, you can convert a traditional business into the same service or product can be delivered in a much different manner today by technology and that obviously will attract VC funding. So I would, my advice would be that if you're people with any business model can go to a sector agnostic fund, but they will have to demonstrate some USP from the way they have been doing traditional business, because traditional business done in a traditional manner to a different marketplace will have only a certain amount of return or probably negative returns because things have changed. It's like, it's like doing a shampoo in a 1 rupee sachet and delivering it to a aspirational population today, which means you've got a great business model even at the bottom rung of the category, and which is a VC investable model instead of, having a traditional business model of huge machines, etc. Plastic molding machines are out of fashion. So a lot of new areas or new ways of doing injectables, like, in the healthcare and the pharma, they have undergone a transformation the way they have been doing things. So I think what we should look at is sector. VCs can be sector agnostic. Somebody can, like Bloom, can only do fintech, or somebody can. So that's the choice of the VC. So that's why, as far as their business philosophy and business strategy is concerned. But yes, traditional businesses, if they change more than looking at VCs not investing in them, they should make themselves attractive for VCs to invest in them or PEs to invest in them. Because I had this chat with a lot of family offices who have sold their original businesses and wanted to get into the new ecosystem. So it's more important that you have, nothing changes. I mean, you have a pivot, nobody's expecting you to have a perfect business model when they invest. But then you need to have the ability to pivot and accept the pivot as you go along. That's the key for investing. And I do not see any challenge for VC investing, sector agnostic VCs investing in old traditional businesses moving forward. But yes, the way or the nature, there should be some efficiency, some effectiveness, or an incremental revenue or a decremental cost, which should be associated with the new way of doing. Otherwise, old wine in new bottle.
Thanks very much for your inputs, and we very well take the point that the traditional business need to do some homework and identify the gaps, in terms of approach of a VC fund and their business model, and bridge that, and then definitely.
On the traditional business, one thing is your kirana stores, etc., like the phygital instead of digital, a mix of physical and digital. But those are all catered by the e-commerce models, which really do the delivery, the Dunzos of the world. So there is some changes in the traditional models, but the small businesses, the retail business. But if you look at the large asset-heavy models, they are not really undergone substantial change, except that they are more big technology driven.
Yeah. Thanks very much for your inputs. Right. So I'll come back to Mr. Manoj Kumar again, right? And I would like to understand from you that the COVID-19 or sudden economic situation. Now if one startup is starting during those times and looking for sustainability in the long run, right? But there may be cases that the pandemic may continue, or there may be different economic situation which will again come. So do you think the startup should be more ready for this kind of situation, where there will be a sudden changes in economic condition, or maybe some pandemic or some other market condition will come which adversely affect their business in a very quick span of time, right? So in terms of their, risk mitigation strategy or to remain, sustainable or relevant in the market, they need to do more homework, and, their business model has to be much more comprehensive.
Yeah, thanks, Nitin. Interesting question, but these situations can be very different. COVID-19 was something we never thought of, and it created a very different scenario, and nobody was prepared for it. But then people adapted to it very fast, right? If you were a physical business, many people found a way to go online, and were able to deliver. Then there were businesses which were digital in nature, which did see. I mean, if anybody says that there was no change in the COVID situation, there was a huge change. There was an acceleration of funding. There was an acceleration of digital models. There were health tech businesses and ed tech businesses which got heavily funded. And there are question marks today. The fact is that there are question marks. There were Me Too scenarios where people did fund any other, ed tech business which came in. Some of them are successful, some are having challenges. The fact is that yes, today kids are going back to school, and they are having, they have now less time for the digital world. So those are facts, and so people. But at the same time, will these businesses get killed? Is there no scope for digital, tech in education? Or no, it's there to stay. Only thing they have to adapt, and that is the reason probably, I don't know in detail, but probably Baiju or others have realized, and there is that physical model also coming up. They bought Akash, which was largely physical. They realized that the teacher student interaction is critical, right? A lot of parents feel that one-to-one interaction, or a student in front of the teacher learns better than digitally, virtually. People switch off videos. I've seen my kids, despite the teacher asking, the videos were off. So the teacher doesn't even know whether the kid is attending the class attentively. There were challenges. I mean, there are challenges in some of these sectors with the digital model. But the fact is that digital is here to stay. How do you adapt to situations like this? Today we have a different situation. We have a war situation. We have an economic crisis building up. Now, can you prepare for all these situations? No, you can't prepare in advance, but you can continue to adapt. You have to adapt to these situations. Now, will all businesses get killed in these situations? No. Neither can you build a business for just a situation, right? Because there were, like, if you see, there were a lot of business models which came just with COVID as target. People made these devices for sanitizing and whatnot, and PP kits and all. A lot of those business models are failing, right? Because those are not long-term sustainable business model, because this situation will not persist. For example, for initially PPs were very expensive, and then they became very cheap, and there was no profitability left because the market was flooded. So you can't design a business model with a particular situation in mind. You have to design a business model. You have to work on a model which is long term, which will adapt to every situation. So digital is there to stay. Businesses, EdTech is there to stay. But yeah, you will have to adapt to it. You cannot make education completely digital. But there are today high-end courses where people join. I know courses which did not happen for 2 years. People were not ready to pay and do a course at Harvard and not visit the campus. I mean, will I pay $100,000 for a course and not go to the campus? No, people did not accept digital delivery. I went to INSEAD, and INSEAD has this program, where they wanted to deliver digitally, but people did not accept. They can accept a part of it digitally, but that whole experience to interact with people. So there are parts of it which can be, there are short-term courses, there is skill set learning courses, programming learning. Some of those can happen digitally. Can a kid learn really music digitally 100%? No, it's challenging. It's difficult, unless the teacher is in front of you. But yeah, people did adapt. They did learn in that situation. that is fine. You should adapt to those situations. I mean, if a pandemic like situation happens again, you should be technology enabled. Even if you are a physical business, should be able to deliver, take orders online, deliver, like the technology enablement of the kirana stores which has happened, the whole enablement of fintech world. Like telemedicine is a very good example. I mean, are people today taking doctor consultations online? No, maybe second consultation you can take online. If you have COVID, you don't want to visit, maybe you can go online. But people are back to the OPDs, right? OPDs are flooded, digital consultations are reduced. But yes, those technologies are there to stay. People will. So there is a change which has happened. There is an adaptation which will happen. So I would say you have to be prepared for such situation. You should be digitally enabled no matter what your business is, and any situation. And wherever possible, if you're cross border, if you're global, it is good. I mean, there are technologies, there are businesses which are global in nature. Like today I was in Dubai. There, the economy is booming in that part of the world today. When war happens, Middle East booms. Oil price goes up. People, there are millionaires shifting to that part of the world. So there is. So if you can adapt, if your business can go and sell in that market, it is good, because there are parts of the world. India, I don't think is, though there is inflation and all that, but India, I think, is doing pretty well today. So there are parts of the world which are impacted, and there are parts of the world which are less impacted.
So I think,
You should be able to adapt to different markets, different situations. That is what I would say.
So I think the approach has to be dynamic, and like you clearly mentioned, the application has to be there. So remain kind of relevant and active, sustainable in I will come back to Dr. Bro for my last question. Sorry, I could not complete my question because of the limitation of time. But it's an extension of the last question which I put on to Mr. Nath and Mr. Alok, is that do angel investor kind of have a preference towards certain sectors or subsectors, or they follow a more open approach in terms of listening to any potential startup and their business model? And there could be two segments within the angel investor ecosystem. One is that who are professionals, another is like who is running some traditional business and have some extra money to invest in startups on some businesses. So what is the difference approach that you identified, and do you really feel that there is a more focus towards particular sectors as compared to focusing on the whole spectrum? You're on mute, sir.
You have asked me 2 questions in one, and I will answer 3 questions.
Okay.
I'm assuming you have time.
Yeah, well, we have time, but I think a lot of participants may be in quick time. So yeah, please continue.
Okay. Yeah. So first of all, I just want to add to what Sridhar had mentioned. You asked about traditional businesses. Why do they not get this kind of funding? And he rightly mentioned they are asset heavy. So they are very, very dependent on a significant amount of capital, right? However, it is possible to do a level of pivoting where you become asset light. So I'll just take a simple example. Suppose you're a manufacturing company, right? And that's a very traditional business, and you're manufacturing. Obviously, to be able to scale rapidly, which is what the angel or the VC want, you will need to invest repeatedly. However, instead of this, suppose you were to create the brand. So the brand is yours. You create the technology, you patent it, and you do the distribution, the support, the sales, the marketing. But the actual manufacture is outsourced to partners. Now, if you want to add volumes to your manufacturing, you don't have capital requirements. Your requirements are basically for marketing and support, right? And for R&D. The guys who need the money is the partners, right? So it's like ancillaries. Product is yours, technology is yours, patent is yours, and you outsource it, right? So that's one way. Of course, it is also true that a lot of such investors look for sexy businesses, the digital, the blockchain variety. But there are enough investors who are willing to look at traditional businesses, provided A, they are low on capital investment, and B, therefore they are scalable, right? So it's possible. Okay, getting back to your question. So first of all, different kinds of angels have different needs. And, angels normally don't operate in isolation. They normally operate as a part of an angel network. So, for example, I am a part of Lead Angels Network. Indian Angel Network is probably the oldest and one of the maybe one of the biggest. Then you have Mumbai Angel, you have Chennai Angel, right? So you have multiple angel networks. Each network could have its own focus. So there would be some networks which only focus on, let's say, digital businesses. There would be some networks who are very, very broad-based. Our network typically is very broad-based. I think the one common thing all angel networks require is A, you got to be a scalable business, and B, you got to have some level of entry barrier. Otherwise, you can't compete with, the other guys who are attempting to grab the same customer as you. So that's one part. The second part, the answer to your third question or your second question is because you are a part of angel networks, right? Typically, when a decision is taken to invest, right, in a particular company, in a particular startup, you have the benefit as an angel investor of all the other investors in that network. So, for example, at Lead Angels, we have several hundred members, all of whom are angel investors. So everybody talks to each other, they listen to each other. Usually, you will get people who are experts in the domain that that startup has made a pitch for, right? And therefore, you get opinions, you get validations from multiple people, and most of them are experienced in the field. So even if you have a person who does not have any background, right? Because usually he'll be investing through an angel network, he has the benefit of the views of all the other guys, and many of them have experience, right? So ultimately, as angel investors, since you're operating out of a network, it's not an issue. Even traditional people who are running traditional businesses can invest. Yes, if you insist that you're running a traditional business, maybe a garment export house, and you want to do it individually, then there will be a problem. The fundamental problem you'll have is most people running traditional businesses expect profits from quarter one, right? And they will sit on the heads of the founder, was profit kyun nahi hai, profit kyun nahi hai, profit kyun nahi hai. And it's tough for the investor, it's also tough for the founder. So my suggestion to anybody who's listening to this is, it is not a good idea to go in and get investments from a person who's in a traditional business if he's in isolation. But if it is through an angel network, that's fine, because in general, people in an angel network, the angel investors, they understand that you cannot expect profits after every quarter. It'll take time. It's a long process.
Thank you very much for your valuable comments. Because of the time limitation, I'm not able to take any question from the audience. I would request each panelist now to have a closing comment. You can just take a minute or so. Referring to the current topic so that the audience can benefit. So I will start with Mr. Alok. Just to give you your closing remarks quickly, and then we can go on to the next speaker as well.
Definitely. Just like I would just summarize what earlier Mr. Sembal said and Mr. Agarwal also said. There is something called a founder fund fit, founder investor fit. That is what Mr. Nath is talking about. Right? So this is very similar to product market fit. So for example, Bloom might not be a fit for XYZ. We might be a great fit for ABC. Because ultimately we are in the business of investing into people. And that is what matters. So that is something that is like the 80% of a preparation for pitching to a fund or an investor. And thanks a lot. Thanks everyone for your time and your support.
Mr. Sridhar, your closing comments.
Since it's the closing comments, let me say what we invest in. We as a venture capital fund, we invest in 3 broad themes, which is clean tech, fintech, and edutech. And we have invested in skill companies too. So, but basically we also have some anything which also linked to ESG investing. So any tech built around this whole thing is something that we look forward to. And we like to follow the 3 rules of a business, which I like the way Professor Dhruv put it across very clearly and bluntly, is that we look at, we believe that anything given free is not valued. So we are not going to be spraying and praying, number one, and we believe in sustainable operating cash flow models. You may be making losses today, but I would be happy to see a pivot or help you to pivot it, because we are operating investors from a mindset point of view. We just don't say that we are operating investors. Right now, when I'm talking to you, I've got a couple of funds sitting and planning their my investee companies. We have supported them too. But yeah, you can make mistakes and come back to me, but and be ready to get corrected and pivoted toward the right business model. That's what we look forward to. So it's tech agnostic. I'm okay, hybrid tech, full tech, it's okay. But then it's more a matter of what we really deliver. So I think if people have that mindset when they get into the startup ecosystem as entrepreneurs, passed out of IIT, IIM, Big Dreams, etc., they need to be focused, saying, I'll deliver value. We have to deliver value.
Thank you very much. Mr. Manoj, your closing comment, please.
Yeah, thanks, Nitin. Briefly to introduce myself, I'm managing partner at C Fund. At C Fund, we are an early stage fund, like many others here. We invest in technology-driven businesses. Our focus is, fintech, health tech, robotics, education tech, and SaaS are some of our focus areas. From our current new fund, second fund, we might do a bit of D2C and Web3. So, just a couple of comments for founders is don't get into a business but just for the sake of doing a startup. Please think through, think deep. We see a lot of business models which are very similar to many others. Like in last 1 week, I looked at 4 models around wealth tech. Everything very similar, with very minor changes, modifications here and there. Look at the market size, look at your understanding of the business. Like Alok put it, we are in the business of investing in people, but at the same time, as people, you should be sure of what you are doing. Sometimes people don't look at the sector deep enough. Every startup comes and says we are the only one, we are unique. So that is sometimes because you have not looked at the market. And when we meet so many of them, we realize that there's many me too. So be very careful on what you get into before you start. It's good to do some homework at that moment, because once you have got into it, it becomes difficult. Though pivoting is always an option, but it's not an easy thing to do. Those are my few comments. Thanks.
Thank you, Mr. Manoj. Thank you. Over to you, Professor Dhruv.
Okay, thanks. So, by the way, you should never have a professor as the last speaker, because you never know when the hell it'll end.
Yeah, I understand.
Okay, I have 2 quick comments. Number one, the one thing that I think every founder, every entrepreneur needs to possess if he has to become successful, if he or she has to become successful, is passion. Right? If your only purpose is somehow I'm going to make money and then I will raise more funding and then I'll make more money, I'll raise more funding, the day you have a crisis, that is the end, right? It will not work. Whatever you start, you must ensure that you're passionate about it, even if it is something as simple as, look at Licious. I recently heard these founders of Licious. They basically give branded hygienic meat, right? They're passionate about it, and you can see the passion coming out of their almost their ears, right? So you have to be passionate, because if you are passionate about whatever you're doing, you will have problems along the way. You'll have COVID, you'll have the demonetization crisis, global financial crisis, all kinds of problems you'll have. If you have passion, you'll figure out a way to overcome these problems, right? So passion, I think, is the first thing. And the second very, very important thing, which I mentioned earlier, is funding is not your goal. If you need the money to grow, sure, take the money. If you don't need the money, don't take it just because you want to brag at a party about the fact that you raised a Series A or a Series B at this valuation. It doesn't work. Focus on your business, money will come.
Thank you very much for all the eminence. Thank you for your participation and time. I think the audience has really benefited, and you have given detailed overview of the funds as well as the perspective of venture capital. And definitely we were able to discuss some of the key sector as well. So I believe the audience can definitely take a note of it and benefit in their long-term journey. I once again thank all the speakers for their time and inputs. And we, as Research in India, look to partner on both sides. We are looking to partner with a lot of funds, as well as guide or partner with the founders and the teams on a regular basis. Thank you very much, all. Have a good evening. Thank you.
Thank you all. Thank you.
Thank you. Bye-bye.